Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, 0% tax if you change employers after age 60. Michael, your topic.
Thanks, Dallas. So what I'm talking about here is we're going to burrow down into legislation here. Yeah. And
But that's why I've led the title with 0% tax, because it at least keeps people a bit interested when they hear 0% tax.
Yeah, well, this is good legislation. This is legislation that will help you move from 15% tax to 0% tax.
Yeah.
So what I'm talking about here, I'm talking about someone that's still working and they're still accumulating. They've turned 60, and they've changed employers. This typically comes up where they've changed employers after age 60. They've either changed employers, or they've gone from they've left an employer and started with another one. They've left an employer. They've started their own consulting business, for example.
Yeah, I've actually even heard of this in situations where the nature of the arrangement has changed. Someone who was a partner in a firm and they're now working as an employee, all those sorts of things. So what you're talking about here is the 15% tax and 0% tax. This is around the earnings on your superannuation, on your retirement savings.
It is. So thanks for that lead in. So basically, when you're in superannuation, a standard superannuation accumulation fund, which most of us are in, especially when you haven't met a condition of release. Yeah. What happens is the rate of return of the money that your money makes internally in there is taxed at 15% on the earnings. You don't see that, and some people aren't even aware of that.
No. Because
the tax rate is the same for every single person, what happens to a superannuation fund, a pooled superannuation fund, is that the ATO comes in and skims that 15% tax off the top.
Yep.
It effectively reduces your after-tax returns.
Yes.
So you're paying that 15% tax. That can be reduced to 0% tax once you've met a condition of release. Now, a condition of release, if you're still working, is that an arrangement under which a person was gainfully employed has come to an end after turning age 60. So the key here is that you have to have attained age 60 first.
Yep.
And then an arrangement under which you were employed, you don't have to be fully retired. An arrangement under which you're employed, you have to cease.
Yep.
So it comes to an end after you've turned age 60. And you either start with a new employer or you don't start with a new employer. There's many variations of that. But where it really comes up is I think people are comfortable with, they can say, I've met a condition of release if I've turned 60 and I've retired.
Yes.
That's an easy one.
And we talk about that often. We talk about superannuation and then moving into pension. And there's a lot of podcasts who've talked about that 0% tax ownership structure of being able to get into a 0%, thinking of that as a 0% company that you can be invested through.
Yep.
So we talk about that a lot. Now, the key here is that it's really just a bit of a quirk of legislation where you don't have to be retired. It's not a thing where you're accumulating and then you fully retire. This is just, like you said, you change employers. You can keep accumulating, you keep working. You just have ceased an arrangement under which you're gainfully employed.
Yeah, and what confuses people, because commonly this is, I finish with one employer on Friday and I start with another on Monday.
Yep.
How have I met a condition of release for my superannuation? And what is a condition of release? So, you've met it because if you've turned 60 already and then you've had that employment come to an end, an employment arrangement come to an end after attaining age 60, you've met a condition of release. Now, technically, you can have access to up to all of your superannuation, even though you're still working and accumulating. And, of course, people say to me, I don't want to access my super, I'm still accumulating.
Yep.
which is true. The real hidden gem here is that you can move the money that you've accumulated in super thus far. You can actually move from being taxed on the rate of return, the money that it makes, from 15% down to 0%. It's still in the superannuation environment.
Yep.
It would still be, commonly with your existing superannuation provider, the statement would appear the same. Yeah. It's just that the tax rate on the earnings drops from 15% to 0%.
Yeah. So and the way that the underlying assets that you're invested into can all be the same, all that kind of thing. Which we've talked about this at length in when you're fully retired. But it's a key point there is that money still, as you say, gets dressed and goes to work for you, all that kind of thing. It's just that you're paying less tax on that return.
Yeah. So this calculation is overly simplistic. However, what we notice from moving from 15% tax to 0% tax, the same high growth investment strategy, what typically happens is that the 0% taxed option earns an additional rate of return somewhere in the vicinity of 0.5% to 1% per annum.
Yeah.
So if for example the superannuation accumulation phase, the 15% taxed super fund earns you 8% for the year, then the 0% taxed option earns you somewhere in the vicinity of 8.5% to 9% per year. That makes a big difference over time.
And the key there is that, as you say, it's not taking on any extra risk. It's not doing anything different. It's just a paperwork shuffle behind the scenes. It's not changing the investment strategy. You're getting to keep more of that return rather than getting an 8.5% or a 9% return and having 0.5% go to the ATO. You get to keep all of that return.
Yeah. So there's a few things to be aware of. So first of all, the technical name for this product, if you like, the 0% tax product, is an account-based pension, which is also known as a super income stream. So we like to call it a super income stream because I think it explains it
better what actually is
a little bit more. So you're required to take a minimum income draw, and for under 65s, that minimum income draw is 4% per year, which is currently reduced to 2% for the year for the remainder of the 2020-21 tax year. So if you got a $500,000 balance, you would actually need to take $10,000 as a minimum income. You have to take an income from this. I'll get into that later. You shouldn't spend that income because it defeats the purpose of doing it. So you take $10,000 for 2021, and then assuming your balance is still $500,000 for simplicity's sake, you would need to take $20,000 a year for the 2021-22 tax year. Yep. Now, because you're aged over 60 and you have to be to meet this condition of release, that income is tax-free.
Yep.
It actually doesn't show up anywhere on your tax return. It's not included in your adjustable taxable income. It's not included in fringe benefits tax calculations or anything like that.
Yep.
It doesn't exist.
Yes.
It doesn't exist, that income. Here's the really, really important point. Now, I've got this in capitals on my piece of paper here, but you can't see that.
This is the key, yeah.
Unless you contribute this back into your superannuation as a personal contribution, you are defeating the purpose of doing the whole thing.
Well, as you just said, Michael, if you make this change, what you effectively do is if you bump up your rate of return by, say, 1%. Now, if you have to take 4% out and you take the 4% out and you blow it, you've just gone backwards by 3%. You've increased your rate of return by 1%, but then you've spent that plus more and put yourself in a worse situation. Now, this is actually one that we saw this for quite a while. In previous years, there was another little bit of a quirk in legislation where everyone that reached their preservation age could move into what they call a transition to retirement pension account, and that had a 0% tax rate. And we did this for all of our clients as they reached that age. Now, when we look back on it years later, we basically worked out that most people would have been better off just paying the extra tax.
Yeah, it confused a lot of people.
They just really, if they weren't disciplined and they weren't really committed to growing their retirement savings, they got that income payment every year. and then they spent it, or there was some reason why they didn't want to recontribute it, and they actually ended up in a worse situation. So that's exactly right. The key here is to see that as that's just money that's come out of that pension, out of that super income stream. It just has to come out, but you can turn around and put that straight back in.
The entire purpose of doing this is to reduce the rate of tax from 15% down to 0%.
Yep.
Now the reason you have to take an income from this, because it's 0% taxed, the government does not want you building up significant money in that. So to use an example, someone with $510,000 of superannuation balance, they've turned 60, they've had an employment arrangement end, they would keep a small superannuation balance of $10,000, let's say in this example. They would potentially open a superannuation income stream of $500,000, the bulk of their balance. The rate of tax that they pay on the earnings on the $500,000 is 0%. The rate of tax that they pay on the small little bit of $10,000 on those earnings in their super fund is 15%. At the end of next year, let me use this example, 2021, they need to take $10,000 as a tax-free income. Like I said, that doesn't show up anywhere because they're age 60 and over. It doesn't show up as a taxable income, doesn't show up anywhere in their tax return, doesn't push other taxable income up into a higher tax bracket. What they would need to do is to contribute. They cannot contribute that back into the $500,000 0% tax pension account. They would have to go into their superannuation fund. So their $10,000 in super becomes $20,000. So they're robbing Peter to pay Paul here. In this case. But what they're really doing is on that bigger balance. If they get that extra 1% rate of return through those tax savings, it's $5,000 they've picked up. It's $5,000 of free money, and we're about using legislation, and we're about taking the bird in the hand. So that's something that's lying on the ground for people, just ready to get picked up.
And it often happens that we meet with someone for the first time when they're 61 or 62 years old, and in conversation they'll say something about, I've only started with this employer 6 months ago or something like that, and it's a trigger for us straight away to go, well, hang on, we can now take advantage of this and pick up this tax saving, which again we get very excited about that, because it's free money. It's a free extra return that you're getting without any extra work by you, without any extra volatility, without any extra risk, anything like that. It's just, like you say, a bird in the hand, and we're all about picking it up.
Look, it's an easy one to mess up, so I will provide a warning here that I would seek professional financial advice in doing this. So that's my recommendation anyway, or my suggestion. Sorry, I can't do recommendations on the podcast. I can do suggestions. And another thing to note, it does count towards your pension transfer balance cap, which is currently $1.6 million per individual. So for a lot of, it's a good problem to have that pension transfer balance cap. So if you're significantly less than that, it may not be a problem for you. It's just another thing to be aware of, though. It's one of those ones that doesn't, it won't, obviously it won't affect everyone.
No.
But it does affect people. There's people that are still working, they've turned 60 and they still want to work for another 5 years. And in that period of time, they can effectively save themselves somewhere between $12,500 to $25,000 in tax on a $500,000 balance per $500,000 balance over that. Cumulatively over that next 5 years, that last 5 years they're working off, which makes a difference.
No, exactly. Like you say, it is an easy one to get wrong, and so it's worth having a look at, getting a professional to have a look at that. But like I say, the key here again, a really clear action step or a trigger or however you want to think about this is that if this is you, if you are over age 60, you're talking to someone who's over age 60 and they've had a change of employer, definitely something that's worth looking at.
And if you would like us to look at that, we'd be only too happy. Please get into contact with us at podcast@mo50.com.au. from anywhere in Australia, we're happy to set up a Zoom meeting with you, and we can take you through that at no cost or obligation.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. We look forward to catching up again soon.